This is the review for the Northstar BCI Managed Fund for Q2 2024. The fund's objective is to deliver inflation plus 5 through the market cycle and to outperform its peer group at lower levels of risk. For the quarter, the fund did about 3.25%, and year to date it's done 4.5%. In terms of exposure, our fund was positioned 66% in South Africa with the balance offshore for the quarter. And equities in South Africa were about 42% of the fund, with 16% equity exposure offshore. Fund had a healthy dose of South African fixed income, as well as global fixed income, and also held about 3% in South African property. In terms of performance, the Rand appreciating through the quarter 3% certainly didn't help global asset performance as we translate back into Rand performance. And a healthy offshore fixed income exposure didn't help either, because global bonds actually did quite poorly, translated back into rands particularly poorly. The fund was also underweight global equities, and that continued to rally through the quarter, and that definitely detracted from performance. On the positive side, SA equities had a great quarter, and we quite heavily exposed to SA equity in the fund, 9%. The local equity team did extremely well, certainly boosted performance. And then the Albi did 7.5%, and that was a massive positive contributor to the fund too, with the Northstar fixed income team having a great quarter. We definitely felt the under exposure to offshore equities, and we'll talk through that through the presentation, why we believe that remains the right call. Now, with respect to some market views and our reasoning for the way the fund is positioned. Just in terms of offshore markets, because that's our biggest underweight, we are very concerned about the level of concentration in global equities. Currently, almost 35% of the market's exposure on the S&P 500 is 10 stocks. This is the highest we've seen in history. It is true that those stocks aren't as overvalued as relative to the rest of the market as was the case of concentration leading into the dot-com bubble in 2000. But there have been 6 periods over time where we've had a high concentration, and in each instance the market does normalize. It either normalizes with the large companies that are heavily exposed to the index underperforming, or the rest of the market catches up to their performance. Either way, we are well positioned in that we have a lot of exposure to stocks outside the large 10 stocks that constitute 35% of the index. Our other concern is not only are these stocks a large component of the index, but they're driving the index's returns, and they are overvalued. Just in terms of global bonds, we think on a 3 to 5 year basis, global bonds offer good value on a risk-return basis. And looking at the South African market, we think equities have generally repriced a lot of the good news, although they're still not overvalued on a longer-term basis. South African bonds have also repriced, and we think are fair value at current levels.